My name's Ryan Beeger. I'm a director at Willis Towers Watson in the executive compensation practice, and I've been working in executive compensation for over 10 years. And just to give you a brief background about myself, I'm located in Chicago. I have a broad variety of clients, both in the for-profit, private, and not-for-profit space. I work across industries. I also specialize in governance issues. So if you're familiar with executive compensation, a lot of issues come out from the proxy advisors, ISS and Glass Lewis, and their views on executive compensation and how that impacts shareholders and how shareholders view executive compensation. So I have sort of a focus on that as well.
Thanks, Ryan. Hi, everyone. This is Lindsay Green. I am also a consultant in the Willis Towers Watson Chicago office, focused on executive compensation. I've been with the firm now for a little over 7 years, and I consult to a wide range of companies, so public and private, and I also have somewhat of a focus on not-for-profit organizations, which tend to face a little bit different issues when thinking about executive compensation. We're excited to speak with you today. On the slide here is our brief agenda of what we hope to cover. We'll start with some executive pay levels and design. We'll talk a little bit about CEO pay ratio, a little bit of a post-mortem. And then we'll hit on the governance environment and some hot topics that we've seen in our consulting work. So without further ado, I think we'll jump right on it.
Okay, so the first page we have here is just sort of a financial overview of 2016 and 2017. I think whenever you talk about executive compensation, it's nice to have sort of a baseline of what's going on in the market, because that tends to have an impact on compensation levels, how they change over time, especially long-term incentives. So as you can see on this chart, 2017 was slightly stronger than 2016 from a financial perspective, especially from a revenue perspective. Profit metrics like EBIT, EPS were relatively flat, but I think the most interesting thing on this slide is that bottom row, total shareholder return. And if you're not familiar with total shareholder return, that's just the return on the stock of a public company over the last year. And so 2016 was a strong year with 13% appreciation. 2017 was 21% appreciation. And so, you know, that impacts how companies start to think about long-term incentive grants and, you know, the value of, you know, your stock options, for example. So that's sort of an important number to keep in mind. And I think also kind of built into that is future expectations. So if you think about the end of 2017, tax reform was a big hot topic, and that was sort of priced into the performance of a lot of companies towards the end of the year. So if we go to the next slide, we have just some information on CEO compensation changes from the most recent batch of proxy statements filed in 2018. And so we have some market data on the next few slides. Most of it's based on some research by Willis Towers Watson on public companies in the S&P 1500. We'll also try to comment on, you know, broader private company and not-for-profit practices as we kind of go through the slides. On page 4, we have, as I mentioned, CEO pay. The top line is sort of the highlight, where total direct compensation. And so that's just the sum of base salary, target bonuses, and the grant values of long-term incentives. As you can see, in 2016, pay was increasing about at a 5.5% rate, and it was kind of similar in 2017, which is higher than we've seen in some prior years for sure. If you take a look on the right-hand side of the page, it's more of a detailed breakdown of what's really happening with CEO compensation in 2017. As you can see, base salaries were increasing at approximately 2.25%, target bonuses at 3%, and the lion's share of the increase was in long-term incentives. And that's something I think we've seen over the last several years, where when companies are making pay changes in providing compensation increases to their CEOs and some of their senior executives, they're focusing on performance-based compensation as opposed to fixed-based salaries. If we go to the next slide, we have some information on compensation mix. And this sort of gets to the point I just made about performance-based compensation. There's an emphasis on pay for performance, and that's kind of a hot topic, or a topic that's been part of exec comp for a long time. External third parties, shareholders, proxy advisors have, as a whole, pushed companies towards performance-based compensation, and it's reflected in the market data at this point. And as you can see on the top half of the page, large cap, mid cap, small cap companies, all of them have the majority of CEO pay tied to performance-based compensation. Similarly, if you look at the bottom half of the page, it provides a more detailed breakdown where salary is really only, less than a third of the compensation package at most companies.
Great. So now, thanks, Ryan. We'll talk a little bit about the different elements of pay with a focus on the results for CEOs. This slide here just shows us the distribution of annual incentive payouts in the most recent year. The chart here shows that from 2016 to 2017 in general, more companies paid an above target annual incentive to their CEO. So in 2017, we found that the average bonus payout was 115% of target, whereas in 2016, it was 108% of target. And like we see with other elements of compensation, we found that these results varied by industry. So this chart here shows the distribution within industry of annual incentive payouts for the CEO. So you'll notice that the financial sector, we saw about 3/4 of companies in the sample paid out with a bonus of more than 110% of target, whereas when we're looking at IT and industrials, only about 50% did. Great. And then in terms of annual incentive metrics, we've seen in 2017 a greater emphasis on profitability, revenue, and individual performance measures. Overall, though, at the bottom left, the CEO annual incentive tends to focus on corporate performance results, and that's really because the buck stops with the CEO. At the end of the day, the corporate performance is really driven by the CEO, supported by the leaders and management team. So we more often than not see that the CEO bonus is going to be based off of solely corporate results. We would say, though, that over the past few years, and as indicated on this chart here, individual performance metrics have increased, and we've seen, recent focus on diversity and inclusion and fair pay. Some of the more strategic company initiatives would be included in that individual performance bucket. One more comment on annual incentives on the bottom right. We've seen a pretty disparate results of the number of metrics used in an annual incentive plan for a CEO. You'll see about 20% have 2 and 20% have 3, 20% have 6 or more. Anecdotally, Ryan and I, we would say that once you start to see more than 6 measures, you get a little skeptical because you're diluting the value of that specific metric. So if you have only 6% of your bonus is tied to revenue, are you really going to be driving those revenue results? So just an anecdotal comment when it comes to annual incentive design there. I'll pass it over to Ryan for some comments on LTI.
So on page 9, we just have some information on long-term incentive at S&P 1500 companies. The top half of the page shows prevalence. So if you're looking at these different indices, the percentage of companies that are granting specific vehicles. So as you'll notice on the slide, the majority of companies now grant a performance-based award to their senior executive team. And as the company grows in size, they're even more likely to do so. 90% of the S&P 500 currently provide a performance-based plan to their senior executive team. Invested restricted stock is still a majority practice, and stock options are still very common. Maybe you've seen a slight decrease over the years in stock options, but they're still very prevalent. And as you think about a public company and how they structure their long-term incentives, they'll often provide what we call a portfolio of vehicles. So they're not just providing the performance plan, they're providing maybe all three or two of the three vehicles to their CEO, depending on the strategy of the company and what they're trying to achieve over the medium to long term. And that's reflected in the data on the bottom half of the page, which shows the relative mix between these three vehicles. I think what stands out is that performance-based plans are now over 50% of the long-term incentive mix for most companies. And there's some very good reasons for that. I touched on some of them earlier. Third parties such as ISS and Glass Lewis, who provide recommendations to investors on how to vote on executive compensation and stay on pay, have a very strong perspective on performance-based pay, and that half of the program should be performance-based pay for CEOs. I think that outside pressure has resulted in companies shifting towards that over time, and now it's reflected in the data very strongly. On page 10, we have some information on, there's some additional information on the vehicle mix between different companies and the prevalence of using different combinations of vehicles. So you can see if they just grant just time vested restricted stock, just options, and then the combination of the different types of mixing and matching that you could have. So that's just really some additional background information. Page 11, we have some information on long-term incentive metrics. And I think we have a little bit of a lag in the presentation. 1 second, we're trying to switch to the next page. Okay, so page 11, we have some information on long-term incentive metrics. The thing that stands out to me is total shareholder return on the left-hand side. I think we've seen a trend towards total shareholder return over the last several years. And now it has been for the last few years, over 50% of companies use total shareholder return. Now, how do they use that? Usually it's on a relative basis. So what that means is that companies are looking at a group of peer competitors, and they're comparing their total shareholder return performance of those peers. So if you're performing above the median, you would get a higher payout. If you're performing below the median, you'd get a lower payout. I think the trend recently that we've seen is that fewer companies are basing their entire performance-based program on total shareholder return. I think you would have seen that more often in prior years. Most companies are now transitioning to more of a combination of TSR and a financial metric. So it might be return on invested capital, earnings per share, operating income, some of the common metrics on this page. And then they pair that with TSR, either 50-50 mix of the two metrics, or they might just use TSR as a modifier. So instead of saying half our payout is tied directly to total shareholder return, we're going to potentially flex the payout up plus or minus 20% based on how we perform. And there obviously are a lot of pros and a lot of cons to total shareholder return. The big pros are that it aligns with the investor experience. It gets companies away from having to set long-term performance goals, which can be very difficult to budget for. If you think about a cyclical company or a company that's in a turnaround situation, how do you set a 3-year goal on revenue or earnings per share in a credible way? But it has downsides. It can be viewed as sort of a lottery. When you get outside of the senior executive team, it's arguable how much control other employees have on the share price and how that impacts TSR. So, as I mentioned, there's pros and cons. The only thing I think I'd mention about this slide is that TSR I've always thought is sort of an interesting topic, because if you think about the history of it, it actually started off in the United Kingdom as being a very prevalent metric there, and it slowly over the years kind of transitioned and basically came over the Atlantic, and now it's very prevalent in the US. And I think the UK and a lot of their governance practices, a lot of their design practices kind of sort of lead the way, and then the US sort of adopts it over time, and we'll kind of talk about that a little bit later with Say on Pay, which also started off across the Atlantic.
Sure. And maybe before we move on from LTI, just a couple comments from a private and a not-for-profit organization perspective. So for LTI, for not-for-profit organizations, we typically start to see prevalence becoming a majority practice at around $1 billion in revenue. We see, 3-year cash plans for not-for-profit organizations typically focused on a mix of a financial metric or a profit metric and something to do with the mission. And that's typically how the not-for-profit organizations with LTI would design their plan.
And I'd say from a private company perspective, it probably depends on what kind of private company we're talking about, but often you'll see kind of phantom-based stock, which tries to replicate one or more of these equity vehicles we talked about. I think you'll see fewer vehicles, so you won't see that kind of full portfolio that I mentioned of restricted stock options, and performance plans. Private companies will often have long-term incentive plans, and they can be relatively complex. So there tends to be fewer vehicles.
Great. So. Okay, so a little bit about CEO pay ratio. I'm first just going to dive into what it is and some details about it, and then I'll talk a little bit about what we've seen as a consulting firm, the reactions to it over the past year. So first, for those of you who are not familiar, this slide here puts into graphical form really what the CEO pay ratio is. So the SEC requires all publicly traded companies in the U.S. to disclose their CEO to median employee pay ratio. This is new for this last year's proxy filing season, and you can see that there's a lot of different factors that influence the result here. So CEO pay is often influenced by industry and company size, company and also individual performance. Median employee pay can very much depend on whether or not you're a multinational firm, what industry you're in, and also which approach you take to identify the median employee. The regulations allow quite a range of methodologies, so it's really difficult to compare CEO pay ratios to your peers. In the bottom here, the SEC even says that they discourage comparison. For those of you who may have had experience with this, it's hard to find a CEO who doesn't want to compare to their peers. So we see that happening quite a bit, but we would just say that we would caveat comparisons tend to be a little difficult to do just based on the differing methodology. This page here just illustrates the different methodologies that a company might take to calculate the median employee. So you could use total cash compensation, which we've seen to be the most prevalent approach. You can use W-2 pay, base pay, total cash plus LTI. You also, if you're a multinational company, you can use the 5% de minimis rule, where you can exclude the company if the number of employees in that company are less than 5% of the total employee base. And you are also permitted under the regulations to use statistical sampling. If it's not clear already, we'll let you know that this has been quite an undertaking for some organizations, especially multinational organizations that don't have one uniform HRIS system. It's caused the companies have spent a lot of time and a lot of money calculating this ratio. And this slide here just illustrates, again, to hit home the impact of the varying methodologies. You really can get quite different results, not only depending on industry, but also within an industry of your median pay.
And I think, if we talk to each one of you that works at a public company, you probably each had a different CEO pay ratio. I think kind of after the fact that, a lot of companies went through the process of going through different analyses and preparations and getting, Q&A documents ready for questions from media. And I think, by and large, the feedback that we've received is that there was a lot. Maybe it's for the first few filers, it created some headlines, but kind of following that, it sort of died down a little bit. And I think this slide is also interesting in that, the CEO pay ratio, that number is going to be large at almost every company. Mm-hmm. The more interesting number could be, what's your median pay for your employee at a company compared to another company. But as we mentioned, it's incredibly hard to compare company to company. So we would actually caution against that. There's so much nuance, there's so much discretion, some best practices in how you should calculate it, but there's so much company to company difference that we would strongly caution you from relying too much on these comparisons.
Yeah, no, that's a really good point. A couple more observations from the CEO pay ratio. So we found that about 11% of companies disclosed a supplemental ratio. So say, for instance, if the CEO received a special one-time award that would inflate the ratio for 1 year. Some companies had opted to disclose two ratios, one with or without that special award. We also saw some companies disclosing the ratio without the cost of living adjustment. Overall, though, I would say that if you've read CEO pay ratios, a number of them, you'll realize that the disclosure and the way that they're communicated in the proxy have really been pretty uniform. The average length is 366 words. That's really short, and companies aren't really taking much initiative to use, to explain a detailed story or to discuss much more outside of the required disclosure. And a couple more comments just from our point of view before we move on. And Ryan kind of alluded this, this was really built up at the end of last year going into this proxy season. And at the end of the day, we've really perceived it to be much to do about nothing. Most companies, really, this hasn't been an issue for them, whether that be optics with the size of the CEO pay ratio or also internally with your median employee pay. Our database found, we surveyed the S&P 1500 and the median ratio was 93:1. We have clients that have, I have clients in experience with companies that have ratios that are 900:1, and it didn't get picked up in the news. So, that was what we've seen in this past year. So there is some uncertainty as to what might happen going forward. So, for example, proxy advisors, which Ryan will discuss in a bit, they haven't developed any policies around this. There could be in the future. There could also be some focus on how that ratio moves year over year. Since this was the first year, we really didn't have to worry about that. And last but not least, there have been some cities and states in the U.S. that have proposed legislation to impose a tax or a fee based on the outcome of this ratio. So it really hasn't gained much traction yet, but something to consider when we're looking into next year. I'll turn it over to Ryan to talk about the governance environment.
Thanks, Lindsay. So just to kind of set the stage, when we're talking about governance, what we're really talking about is how companies work with their shareholders and the other third parties out there that have a strong influence on executive pay. So I've mentioned these organizations twice already, I think, but just to level set a little bit, the big players in this space are ISS and Glass Lewis, and they're proxy advisors. So what that means is that investors will basically hire them to do research. They'll sort of outsource research. And ISS and Glass Lewis will every year look through proxy statements of companies. They'll analyze the executive pay, and they'll make recommendations to shareholders on how to vote on say on pay. And say on pay is just the annual advisory vote on executive compensation, so that every public company goes through each year. And basically what that means is that when there's a proxy statement with executive compensation disclosed, shareholders now have a tool to maybe voice their displeasure with the company or with the executive compensation program. So as you can imagine, if shareholders vote against the executive compensation package for a company, if there's just a low level of support, that can create headlines. And I think that's, if you look at the headlines in the Wall Street Journal about executive compensation, often it's tied to the results of a major company on say on pay. Boards of directors, management teams want to avoid this negative kind of optics of a poor result, and often will actually change their compensation programs as sort of a kind of their responsiveness to say on pay results. So in 2018, the support level was about 90%, which means the average company in the S&P 1500 had 90% of their shareholder base vote in favor of say on pay. So that's very strong. It's sort of consistent with prior years. And for that other 10%, you know, there's a wide variety of investors out there. Sometimes there's institutional investors that have their own policies that they're kind of looking at on an executive compensation basis. There's also pension funds out there that might vote against executive pay, and there's activist investors that might be voting against for that kind of other portion at some of these companies. Page 19 is just an overview of shareholder engagement. So I think this is sort of a trend that's been increasing over the last several years, in that companies want to kind of build relationships with their shareholders. It's great to be proactive and talk to your institutional shareholders and understand their views on not just executive compensation, but a variety of other topics. And as companies try to build these relationships, hopefully the end result is that if there is a problem from a governance perspective, if you're at a company facing kind of a tough year, a tough total shareholder return year, you can work with your shareholders to understand their issues and potentially get ahead of any potential optics issues, as I just mentioned. I think the next page is just an overview of some other third parties out there. Obviously, Glass, Lewis, ISS, the proxy advisors are, have a very strong influence in executive pay, but there's others out there to keep in mind as well. BlackRock, an institutional investor, had a letter where Larry Fink talked about company strategy, social purpose, long-term value creation as very important to them when they think about investments. And that is sort of an emerging trend where companies or investors are thinking more broadly about companies as opposed to just kind of a narrow focus on executive compensation. Though I think the bottom half kind of gets at that. Things like social issues, environmental issues, fair labor practices, ethics, culture. These things are growing and growing, and I think we're going to see a continued trend towards these broader issues, and it's going to go all the way up to the board of directors. So if you're working at a public company, you might be hearing more often from requests from the board of directors to think more broadly about executive compensation issues. Page 21 is just some information on say on pay. This is really just for your reference. As I mentioned, there's a 90% support level on average in 2018. And about 3% of companies failed say on pay, which means more than 50% of the shareholder base voted against the program. And when that happens, the lights kind of go off at a company, and you have to scramble. When that happens, as I mentioned, companies will often reach out again to their shareholders and start to talk about issues and see where the problem may be with pay programs. And often companies will make changes to their pay programs and designs as a result of that. Just for your information, ISS is the most prominent proxy advisor out there, and 14% of the time they recommend a negative vote. So they're telling shareholders 14% of the time to vote against a compensation plan or the compensation program. And I think also interesting is the line below that 14%, which is 31%. So that's the difference between when ISS, the difference in the vote result when ISS has a for and against recommendation. So I guess you could think of it as if the average is 90% on a whole, when there's an against recommendation, the vote average is probably closer to 60%. That's not purely driven by ISS, because if ISS comes out against a plan, there are probably other people that have very similar perspectives that don't sort of blindly follow ISS's recommendations. But interesting to see that there is such a striking difference in results. The next page is just a little bit more information on when ISS makes an against recommendation. As you can see, the most common reason is pay for performance. So we're sort of in a situation where companies, not every company is going to overperform over the long run, year after year. And so when there is sort of a disconnect between the compensation program and performance, most commonly measured by total shareholder return, ISS is more likely to make an against recommendation. So pay for performance is now the main driver of against recommendations. I think if you look back to when, if you think about Say on Pay, it was part of Dodd-Frank. It's been around for almost, I think, now 10 years. If you think about executive compensation 10 years ago, there were a lot of practices that were prevalent that are no longer prevalent. Things like excessive perquisites, golden parachutes, tax gross-ups on termination benefits, things like that have slowly over time sort of gone away, and now the focus is really on tying pay to performance. And then page 23 is really just some more information on common issues for companies with high pay for performance concern, sort of as noted by ISS. I think really the most interesting one that you should think about is the top one, the rigor of incentive plan metrics. And so I think a lot of companies are thinking about this, regardless of what ISS or Glass Lewis would say. Companies are taking a closer look at how they set performance goals. They're doing a lot more modeling, sensitivity analyses, probability analyses to really try to have rigorous incentive plans and goals. And I think it's something that the external world is looking at more closely too, including ISS. So I think that's going to be a trend that we continue to see. And then finally, this is just some information on another shareholder proposal that you commonly see, equity plans. So when companies request shares from shareholders, and similar to Say on Pay, there's a 90% support level, but companies actually very infrequently fail these sorts of requests. And I think that's just because while Say on Pay is non-binding, it's more of an advisory vote, this is a binding vote. And few shareholders are going to vote against the request to get additional shares, because that sort of hamstrings the company from granting long-term incentives if they don't have equity.
Great. So before we dive into hot topics, I just wanted to bring it back and connect it a bit with the private companies and not-for-profit organizations. So while the CEO pay ratio and proxy advisor directions and votes, they really do apply only to public companies, we've seen not-for-profits and also private companies starting to think about these new regulations and requirements and bring them into their own organizations as well. Just because they may not be susceptible to these rules just yet, the talent market has increasingly universal, so the not-for-profit and private sectors are looking to the public sector for talent, and also the optics are really increasing. So there's an increased focus, regardless of the ownership or status of your company, on some of these pay for performance alignment issues. CEO pay in general has always been a focus. So I'd say the topics are not exclusive to public companies. Great. Okay, so we're going to dive into a number of hot topics here that we've seen over the past year, and one that I think has just been overall something we've seen again across all types of companies and organizations is how the role of the compensation committee has been evolving. In the social landscape that we live in today, in the era of Me Too, corporate scandals, as Ryan mentioned, the Larry Fink letter with a focus on purpose, increased shareholder activism, increased media focus, really seen an increase in responsibility for the compensation committees. Compensation committees are considering expanding their remit, so revising their charters to include For instance, diversity and inclusion, which is, not necessarily just an executive compensation topic, but also a topic for the broader population. The committee is seen really as the closest line to the company's talent, and they're really reporting back to the board on various talent issues. So there's an increased focus on it. So we'll talk a little bit about clawbacks, fair pay, that those are all becoming committee level conversations. And Ryan mentioned earlier too, the rigor of incentive metrics, really making sure that pay and performance are aligned. And also now, after the Larry Fink letter, there's more companies focusing on whether or not they have a positive impact to society, included in their incentive metrics. So, we see a little bit of not a blurred line, but there's a very fine line between the compensation committee's governance role and in the C-suite's management role. But we'll find, I think, over the coming years, is there's increased pressure and focus on the compensation committee to be accountable for these broader topics. We'll find some push and shove between management and committee members really wanting more information so that they can make informed decisions on how to govern the organization or the company, and management having to provide that information, but still making sure that they're managing in the board's governance. A quick overview on clawback policies. I know we can all name several corporate scandals over the past few years, and these corporate controversies have really been causing committee members to ask the question, what happens if that happened here? So the SEC does now require public companies to have some form of clawback for financial restatements, but seen an increase in companies adopting more broader clawback policies. For instance, ones that might be discretionary based on the committee's judgment or the board's judgment, but also ones that include reputational harm or misconduct. So for instance, I'll get into the types of questions, but before I get there, I'd like to highlight the Mylan case. I'm not sure if you all are familiar with it, but Mylan had increased, they charged 1,000% above margin for the EpiPen. And while there was no impact on their financial statements, after this was announced and released and leaked to the media, their market share and stock price took a huge hit. Mylan didn't have a clawback policy that allowed for reputational harm. So the committee was and board were hamstrung. They weren't able to claw back compensation from the executives who had made this decision that caused reputational harm to the company. So companies now, boards and committee members, are asking more detailed questions. So for example, do I have the tools to recoup pay depending on the controversy or the circumstance I find my company in? Does my clawback cover reputational harm? So I think we'll see as these scandals continue to fold, and I don't think that there's going to be less of them going forward, as these scandals continue to unfold, I think that we'll see companies and committees talking about broader clawbacks going forward.
And on this page, we have some information. Actually, the next two pages has some information on some proposed legislation that's out there. As I talked earlier, proxy advisors have sort of a lot of power in the world of executive compensation, and there's current legislation out there to further regulate these organizations like ISS and Glass Lewis. You can kind of read through these at your leisure, but some of them actually seem a little tongue-in-cheek. Like you should have sufficient staffing to provide voting recommendations. I think that's sort of an interesting thing to have in a bill. But I think the issue here is that not only do they have a lot of power in the executive compensation world, but there's a perceived conflict of interest. So ISS not only helps investors make decisions, but they also consult to companies on their own policies. So a lot of people view that as sort of a conflict of interest. And so I think that not only that, but they want to make the purpose of the legislation is to make things more transparent so companies can respond to recommendations, have kind of a transparent view on why ISS and Dirk Lewis came out with their recommendations as well. So if you think about the current environment in Washington, there is support for this, but there is a lot going on, and this may not be a pressing issue until after the confirmation of the Supreme Court nominee and especially the midterm election. So to be determined if and when this picks up steam, but we wouldn't expect it to be anytime in 2018.
And our last hot topic before we open up the lines for questions is the increased scrutiny on share buybacks. Share buybacks recently hit $1 trillion, and there's an increased focus on them because of tax reform. Companies have more money, and if they're using that money to buy back shares, there's been some negative connotations that's associated with that. So for example, when you buy back shares, you inflate EPS. As Ryan went through earlier in this presentation, EPS tends to be a metric included in annual and long-term incentive plans. If you increase your EPS by buying back shares, you're also going to be getting a larger bonus or a larger payout on your equity. Another complicating factor, or a factor that's being looked into, is that when companies buy back shares, it causes share prices to increase because it signals to the market that the company believes their share price is undervalued. So again, Ryan mentioned earlier, TSR, or share price appreciation, is included in many long-term performance plans. So increasing the share price could result in a larger LTI award payout. So the Wall Street Journal recently picked up on this, and the Democrats have introduced bills to potentially limit this. While we don't think, with a Republican-controlled Congress right now, that this will gain much traction, we would say, we're curious to see how this develops going forward. I think, if the control of Congress changes and potentially president changes, and the media continues to focus on this, we wouldn't be surprised several years down the road if we see some traction here.
Okay, I think for the last 5 minutes, we just have a brief wrap-up slide, which try to tie some of this back together. I think these are some key takeaways we would give you when you're thinking about executive compensation programs at your company. First one, tailor your program to specific company strategy and execution. I think, for several years at Willis Towers Watson, we've consulted to companies and we've tried to find ways to tie strategy to the compensation program. And I think if you think back to all the kind of data and information we saw, often you'll see companies try to do that through, the annual bonus plan. I think that's something you see often where there's individual metrics, there's strategic metrics. You can really kind of tailor your program to your company. And obviously the program should fit into a total rewards framework and perspective. While a lot of the information and data that we have is based on what we consider to be traditional total direct compensation, companies are thinking broader than that, thinking about their benefits program, how programs cascade through the organization. Ensure you have decision quality global compensation benchmark data. I think maybe a shameless plug, but at Willis Towers Watson, we do have great data on global compensation. It's sometimes hard to get, but the data quality is increasing year to year. Companies are thinking more broadly about compensation internationally. How do you design a long-term incentive plan that covers a bunch of countries? We now have data on pay practice at multinationals in countries throughout the world. Obviously, review your incentive plan performance metrics for appropriateness. I think that kind of gets at tying it to your strategy and having rigorous goals that you set and hold people's feet to the fire. And finally, human capital risk. I think, as Lindsay mentioned, there's a trend towards clawbacks. I think we also see many companies taking a harder view or a closer look at the risk profile of their programs and doing risk assessments and making sure that there's not undue risk in the compensation program. So I think really that's the end of the presentation. I think we have about 10 minutes for any questions. So happy to take any questions that there might be.
I'll open the lines now. The lines are not open.
Okay, well, thanks everyone. If you have any questions, please feel free to reach out to Lindsay or I, and we'd be happy to connect.
Thank you, Ryan. Thank you, Lindsay, for today's presentation. We also like to thank our ongoing sponsors. There's a full list of our sponsors on our website. We also ask for you to fill out an evaluation form, which you will receive via email this afternoon. These evaluations are very important to us. It helps our program committee help develop our future program. Everyone, please stay tuned for further 2018 programs and events. You can visit our website at www.chicagocompensation.org. Thank you all and have a great day.